Peter Rose, Longwood Currency Trading. Good morning. It's kind of a wet, very cloudy, actually not cloudy, it was dense fog this morning, mid-May 2022. And the topic I wanted to discuss today is how to do Forex lot staging analysis. I've had a couple of videos recently that brought up this staging process, and I haven't really talked about staging much before because I don't want to give the impression to those of you who are in your early stages of your journey in Forex trading, less than a year, you know, trading a couple of mini lots and maybe less than a couple of hundred trades, that you should be even considering doing lot staging. It just complicates things because it's my position, again, for the 9,000th time, that if you can't go all in, all out with one single mini lot and be successful and develop a good win-to-loss ratio, then you don't understand opening analysis, that first phase of the position life cycle. You have entry analysis, position management, and then exit methodology, right? So if you don't understand the whole process of entry, your win-to-loss ratio is going to be crappy, and you're not going to fix that by trying to stage. You got to fix that on a single mini lot basis before you go to 2 mini lots or a full lot or a six-figure account. You really do. But when you get to the point where you're actually working diligently on that one lot in, all out, you need to be aware of the process of staging so that you can sort of think about that as you're going through your work. You can't slip off the edge and actually do it. You just have to say, gee, I wish I had, 6 lots at my disposal here, because I'd put, a couple in now, and I'd wait, and then I'd do this, and I'd pull one off, and, do all that sort of stuff. You just have to get a feel for that entry work that you're doing. Now, I talk a lot about entry analysis, and the process that I use is I don't look at a trade. I always look for the profit first. I don't worry about the risk because I set my risk at a static level. And I'm a day trader, and so I'm on the 5-minute chart. I'm getting my bias from I'm doing multi-time frame analysis. I'm getting my bias from the upper time frames, and then setting out my trading plan for the day, which is going to be a 2-hour period because I don't want to sit there at the computer for more than a couple hours and make a trade. I got done watching a movie with my wife last night, and I went in and I had some stuff on the computer I wanted to do. It was like, it was 8 o'clock at night, and my trading platform was still up. I hadn't done any trading. It was a Sunday night, actually, and the markets had just opened, and we had a friend over yesterday, and so I wasn't really doing any trading when the markets opened at 5 o'clock. So there I am sitting at my desk at 8 o'clock at night going, oh, that looks like a good idea. So we'll just get into that while I'm sitting here managing this thing and see what I can do. I made $630 or something like that in about 20 minutes, and then went to bed. So I don't want to sit at my computer for hours and hours and hours. So all of my trading is based around short stop, get out if you're not going to immediately right, and if you are immediately right, load it up and get out, because I've identified there's at least 20 or 30 pips of potential profit there if you wanted to sit there long enough to get it all. But within a couple hours, if you can't get 10 or 15 pips of that, 20 pips, then it isn't really a good trade, and you get out with a 3 pip or 5 pip gain, or whatever it is. So the issue becomes when you start trading with size. Let's say you're trading with a $100,000 account and you're trading 10 fulls. I don't think it's a really good idea to go 10 fulls in, because that's $100 a pip. So if your stop is at 10 pips, that's $1,000. And if you're going to hit the statistical 6 losing trades in a row at some point, that's $6,000 that, man, that's gone. And so if you haven't really done the incremental increasing from small accounts to a little bit larger account to a little bit larger account, and learn how to gradually step up your game. And I had a video about the problems and issues that are involved in doing that recently. And so I don't talk about the staging, because we're generally working in training to try to help you get a good win-to-loss ratio without doing all the fancy stuff, compounding, staging, reverse ads, all this other exotic stuff that I would cover like in an advanced class for someone who's either gone through my courses and done some consulting with me, and they go, okay, I get all this stuff that you're talking about, but how do I really load up the truck and back it up and trade with some size here and get some stuff going? I traded 6 full lots last night to get the $600. I made 1% in 15 minutes. But I didn't start with 6 full lots. I knew that the momentum was there, or I felt that the momentum was there. So I went in with 3 lots. Those hit. It went a little bit against me. Then it came back. I did 3 more lots, and it hit my stop, and my average was up there, so that I got the $600 gain. But when you're dealing with just 20 pips of real estate in order to stage your lots in, you got 20 pips to stage 10 lots in. Is that feasible? Well, no, for the reasons that I just said. Well, what if you start with 5 and then add 5? Oh, great. Where are you going to add the 5? How are you going to protect your? If you go in with 5 and add 5 when it's gone 5 pips, and then you have a 10 pip retracement, you're still going to get bopped out with 5 of those lots, and you may it may go farther than the 10 pips. It may go to your stop point, 20 pips. You've seen a 20 pip pin bar, for God's sakes. You know that can happen. You could be out 10 lots, and just like that. So where do you set that second 5? Or do you go in with 3 and then do 3 more and then do 5 or 4? Well, now your average is up there, and so the profit target is here, and now you get a little spike down, and you get hit with that average that's been pulled up. All right, so what do? You start with 5, and you add 1, and you add 1. That keeps the average down, but again, you're adding so close to your original take point that any kind of downward movement is going to you've loaded up the bus. You've got 8 lots, and it spikes down, and what are you going to do? You're going to bring your stop up to break even, and you've loaded up 8 lots in that point. Your stop is like 5 pips or 3 pips away, 5 pips away from where your average line is for all these 10 lots. You could fart and move the price 5 pips. So the dangers in staging are very high. But what are you going to do when you're trading with size? That's why one of the options is that you really don't need a lot of size to trade, because if you're really, really good and you've got a high win-to-loss ratio, scalping, then you trade small and you trade many times. So you might have $100,000, which you would want to have in case you're trading with the 30 lots or the 3 lots that you're trading with, and you lose 6 of those in a row on a scalp. You've still got plenty of dry powder, so that you can continue to trade your 3 full lots. I mean, that's how you do it when you're scalping. So you're trading with 3 lots out of the 10 that you have available, and you're trading in and out many, 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 many times, and you're trying to get 3 to 5 pips each time you go in to trade. And so you're going to have to make 3, 4, 5 trades in order to get 10 or 15 pips of profit on the 3 lots. So you might be able to get 20 pips of profit by going in and out and going back and forth on those 3 lots. So you've got $30 times 20. You've made good money, right? You got $600 there on 3 lots. The problem is those losses when you're scalping, right? What are you gonna do? You got to get out right away. You lose 2 and you lose 2 and you lose 2 and then you make 5. So you've ended up making 1. Okay, that's what you do as a scalper. It's very, very, very difficult to do that. But if you're trading with some size and you make 5 points on 10 lots, you made $500. And how tough is it to get 5 points? Well, it's not too tough when you're trading all in, all out. But if you're trying to trade with size and you don't want to lose a lot when you lose, then you have to stage. And it's only after trading that larger bank that you have developed a full set of maybe 10 series of your win-to-loss ratio. So if you're a 60-40 trader, for example, that's over 10 trades. You're 6 out of 10 that you're winning, and you need to do 10 of those, or basically 100 trades, to make sure that that win-to-loss ratio is really good, so that as you're there doing that as an all-in, all-out process, or maybe you go in with half and then you add to that halfway through the trade to the 10 pips. So you add at 10 and then you bring your stop up. You've got you go in with 5 and then you add 5 more at 8, 10 pips or something like that, and bring your stop up to break even. And so you lose on the 5 lots that you put in, but you make 5 pips on the or break even, or make 5 pips on the original entry level, and so you come out okay, or you come out losing about half of what you would normally do. So how do you figure that out? Well, one of the easier methodologies of doing that is you still stay down as a day trader, but instead of trading looking for profit targets that are 20 or 30 pips away, you've got to have a clear path to 40 pips so that you can stage in a reasonable amount of your lots, so that if you get tagged out, you've made a good amount of money for the day. How much is a good amount of money? Well, if you're trading a $100,000 account and you're dribbling these things in, say at 2 lots at a time, you're going to get 4 lots in before shit hits the fan. And so if you make 5 pips on 4 lots, you've made a couple of $100. Now, there's a lot of people who don't make a couple of $100 a day, and so even though you're trading with a $100,000 account, and you say, well, I made $200 on this $100,000 deal that I did, or the 40,000, or whatever you are going to calculate that gain on, even the 40,000, $200 on a 40,000 is, is 0.2%. But look, if you can make 0.2%, 5 days a week, you're making 1% a week. So you're making 50% a year. So you have to really look in terms of the percentages overall that you're talking about, so that you don't get discouraged trading a large amount of money and only getting a small amount of gain, because you're getting that gain every day, that small amount every day. And look, if you're in the current situation that we're in right now, a CD is paying 0.03%. 10-year T-bill, you might get, I don't know, 1.5 or maybe 2%. So you put $100,000 in, you get $200 at the end of the year. If you had a $100,000 account and you made $200 a week, you're doing fine. But the trick is, in all of this stuff, is it's not how much you make, it's how much you keep. And the keeping part has to do with your risk management. And so when you get into the staging, the risk management becomes primary, because you're in the trade and now you're in the position management stage. And so you're out of the entry theory. But you see the bleed through between what you're trying to do at entry and then how you're going to manage that position by staging as you move forward into the life of that position. So how do you do the analysis on that? What's going to work for you? Well, as a software engineer, I've written a lot of simulated applications, and so I thought this would be interesting. I've done an application that analyzes staging out of a position as opposed to staging in. And there's a happy mix between staging out and staging in. They work kind of in harmony and parallel together. The issue there is that you want to make sure over the long period, when you're working any particular kind of methodology with a lot of money, that at the end of the day, you're coming out with at least a 0.3% gain or a 0.2% gain on your money. You've got to be gaining something because you're a day trader, so you're just trying to knock that out. 0.1% a day is 0.5% a week, right? And so 0.5% a week is 2% a month. That's 24% a year. Basically doing nothing, right? It's the loss that you have to be concerned with. And so when you're doing your analysis, the idea is in balancing where you're putting your stage points, how much you're staging, and what are you going to do with the trailing stop. Those are the things that you want to manage. And so what I did, and I'm writing this simulated application right now in Enterprise Java, and it isn't necessary for you to do that. I'm going to throw up a slide here that shows my initial whiteboard development of a staging in process. And I had to draw this diagram about 10 times. I had to go through these calculations about 10 times until I settled on this. Well, this is one of the iterations that we're going through. So you have to whiteboard the thing first to get the happy path. Well, this works if everything works, right? But what happens if it doesn't work? Well, what causes it not to work? It would be the price action, right? And so what you have to do is build up a series of these orders, these transactions that you're going to make at different times. And then you put it into a simulator where you throw a price at it. And you say, did this price, here's my first order, or here's where my stop is. Did price hit this order? If it hit this order at the point where you have a limit order, then you create a transaction and you make that. Now what happens with the next price? Where does that go? Does it move in your favor? How much did it move in your favor? How much do you want it to move in your favor before perhaps you either start staging or you move your stop to break even? And then what happens if the price goes against you? How does that balance? So you have this set of orders that you're going to make when price hits certain points. That's what the whiteboard analysis does. You're assuming the happy path that price is going to do this particular thing, and if it fails at any given point, this is the amount of money that you're going to make or lose. That's the happy path. Now, when you put it into the simulator with random price generating, you could hit those 6 losing movements in a row. You could hit 4 or 5 of them and then all of a sudden have this massive spike down. So what you're doing is you're trying to find, how can I refine this? And so you go into the set of orders that you've had, and then you change that. You make a change in it. Then you run the simulation again, maybe 100,000 times. And then you make another change in those orders, and you run the simulation another 100,000 times. And you collect each one of those runs in what we call metrics beans, or metrics objects, that hold the results of that simulation, including what the parameters of that simulation were. And you store them all into a summary bean or object, and then you go through that summary object and find the one that has the greatest end output of value. And the result of that is the result of running 100,000 iterations against how many ever changes of parameters that you want to make. So if you have 4 parameters, remember what I was talking about is that if you have 3 parameters, you've got 21 different permutations you can put those parameters into, which means you're going to do 21 times 100,000 iterations of that iterative process. You're going to create all those results to analyze. That's the power of what you can do on a computer. If you don't have the computer and you don't know how to write simulation code, then you have to do what I did, which is get on the whiteboard and do it manually. Look, if you haven't traded very much, you're not going to be able to do that because you won't know what's expected. You know, you look on a 5-minute chart and price gets going and it has a retracement. And it always has a retracement. On the 5-minute chart, what's that retracement? There's anywhere from 15 to 25 pips. You can have a major retracement. I've had major retracements of a couple of 100 pips. I'm in a position right now where I've had a retracement. I've got about half my position in there, and I've had a retracement, and we're still having some volatility from the other day, so I don't have a stop there. But I'm not trading with my full size. I'm trading small. I'm willing to take the big loss because of the structures that are around me. It'll come back. It was, I don't know, a couple of $1,000 against me. Now it's a couple of $100 against me. So it just flops and moves around. Is it going to work out? I don't know. Maybe it will. Maybe it won't. But I made $630 yesterday, so that could balance off maybe $600 or $800 loss that I may have today. I'm not planning on having a loss today, but you know, we just have to see. So they carry trade. But what I'm doing is I'm experimenting in real time with real money with one of the theoretical methodologies, systems that I did on the whiteboard. And so I'm looking to see what it does. But we're having, if you're only going to be in a trade for 20 pips, you're probably not going to have a major retracement if you've done your entry theory the right way. It'll get 10, 15, 20 pips before it starts to flip over on you. But if you're looking to stage in and you need 30 pips in order to get 15, in other words, you stage in one thing here and then you stage in the same amount here, the average line becomes right here in the middle, yeah? And so that middle might be 18 pips. So if you have a profit target of 20 pips, you're making 2 pips on the whole load, and that's not gonna get you. Well, I don't know, 2 pips on 10 lots, you know, a couple $100. So you can do that and work through that type of thing. But the thing that I'm trying to do is get a better feel for what those potential retracement are under varying types of market conditions. The other day when I was talking about volatility and some of the movements that were going on in the market, we were having retracements of 200 pips. And when you're in a, quote, normal market, which we're not right now, but the normal market, you tend to find a 15 pip retracement is pretty normal. Well, when your profit target is 15 pips and you're moving in that direction and you get a 15 pip retracement, you better know where your stop is so that either you don't get caught out too late and you lose everything and that becomes a 25 or 30 pip retracement, but you don't want to get out too soon either. And that becomes a real problem when you are when you're staging. Now I'll throw up another screen here for you and just show you one of the programs that's in this simulated test. This is the controller showing what I'm doing. I'm going out and getting all these orders and I'm bringing them back, and then I'm going to start iterating price. I'm going to start throwing price at the orders and seeing if they go. But it's just the first step of building the application. It's just building little pieces and putting them together, and that will come out probably, hopefully I'll be done with this in 3 or 4 days, and if I can get some time without chasing a dog around here, and then maybe I'll do another video and talk about some of the results that I got. Although again, I'm not trying to teach how to stage. I'm only trying to explain to you how you go about doing the analysis when you get ready to go into the staging process. Every time you make a change in your position size or what you're going to do with your position, you need to really step back, do some whiteboarding on it, and try to figure out, do some analysis on what that big picture is. Don't just go, oh, I think I'll do this and start doing it, because that's not going to work. You have to step back from it and look at what price action characteristically does under the different conditions that the economy is going to make it work in, what the order flow is going to do, and then you have to work within the constraints of determining different methodologies for dealing with a trending price that you're going to be in, or dealing with a price that's range bound and perhaps is clipping your profit targets a little bit shorter. If you're a longer term trader, you can play for the breakouts. If you're a day trader, you're trying to play between the ranges, and you need to have enough room between those ranges so that the third of the movement that you catch is significant enough to make the risk that you're taking worth it. If you only have a 20 pip range, you're going to only try to catch 6 pips of that, right? Because you've got to make sure that the movement has the momentum to move in that direction. Don't you think you need to wait 6 pips, 6 or 8 pips to get in there? And then you're going to watch that go, and then as it gets through that 6 pips, and it starts to go toward wherever that profit target is, you only got 6 pips there. That could be a range, like if you're trading to a resistance level. That range could be 5 pips on either side of that. So that thing could start to stagger. So as it starts to come, maybe it's gone up 17 pips toward your profit target, and you notice that it starts to stagger a little bit. And I've done videos on what to look for as far as staggering, as far as the momentum, and the candle size differential between the current candle and the ATR. Okay, big deal. So that's why I say, you're only going to get that 6 pips if you're careful. if all of a sudden you get a retracement that spikes down and you get 1 or 2 pips, you've taken a lot of risk in trying to get that. And do you think you're going to stage into that 20 pip thing with 5 pips at the open, or 5 lots at the open, and 5 pips at the 10 pip level, because that brings your stop up 5 pips. I mean, your average up 5 pips. So now you're at 10 pips, and you've added 5 lots more, and your average is 5 pips away from that. Well, Jesus, a regular candle ATR is going to bump that, and now you're going to be into negative territory on 10 lots. See what I'm talking about? Okay. So the importance of this video is to stress to you not only to be doing some sort of whiteboard analysis if you're going to be doing staging, but to everything that you're looking at in your trading in order to build your trading plan, in order to build your strategic approach and your methodology for implementing that through tactical implementation, so that you end up making money. That's the tune. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.